So we will start with quantitative methods. First 5 readings are from ethics. Ethics is something that we will be doing at last in the end. So let's start with quantitative methods, and this is reading 6. First reading of quantitative methods is time value of money. So quantitative method, just to give you an overview, will be teaching you the basics of finance. That is how to calculate present value, how to calculate future value, what is time value of money, what is discount rate, and all that. And this would lay down this time value of money, and this would lay down the foundation for the whole course. So when we talk about the finance, the very basic thing or the very foundation of finance is time value of money. So everything, call it valuations, call it decision making or anything, all the decisions are taken based on time value of money, and investments are made analyzing time value of money, and valuations are done using concept of time value of money. So this is one of the most important concepts in the world of finance. If you learn it, then you learn the finance, I would say. So first topic is time value of money. Then after explaining time value of money, it moves further to discounted cash flows. Then move further to statistics. In statistics, it will be teaching you the basics of statistics like frequency distribution and all that. After that, it will be teaching you probability. After that, it will come up to hypothesis, and after hypothesis there is a small reading on technical analysis. So this is what quant comprises. So let's start with the first reading, that is time value of money. So before we discuss the questions or we go on to discussing the concept, first let's understand what time value of money is. So time value of money means, let's say that if you have $100 as of today, and maybe you can buy goods A and B from this $100, or maybe you can buy 10 units of goods A and B from this $100. If you keep this $100 instead of buying these goods, then you will again have $100 after a period of time, let's say after 1 year. So time value of money says that although in absolute terms the cash is constant, that is you had $100 1 year back, you have $100 as of today. So although you still have $100, but this $100 is not equal to the $100 that you had 1 year before. That is, the value of this $100 has reduced. So this is what time value of money is. Time value of money means that money tends to lose value over time. So $100 or $1 or any amount as of today will not be the same as any amount after 1 year or 2 years. So this, maybe with this $100 you are not able to buy 10 units. Maybe for the same products you are only able to buy 9 units or 8 units or whatever. So that means your money or your cash has lost value. So over time money tends to lose value, or your funds tend to lose value. This is time value of money. And there is obviously a rate at which it loses the value. So let's say it has lost value by 10% or 20, 15%, 12% or whatever. That rate at which it loses the value is your interest rate or is your discount rate. And how do we come up with that discount rate? So discount rate is that rate that can convert this present value to future value, or this future value to present value. So just to further clarify it, if you have $100 as of today, then you would have multiple options. Maybe you can invest this $100, it will become 110 in future or some other amount, or maybe you can keep this 100 as it is. So if you are keeping this $100 with you as it is, that means you are not investing it. If you are not investing it, then you are foregoing that benefit that you could have had you invested it. So you are foregoing that benefit of investment. So if let's say an investment is available as of today, and I tell you if you invest $100 as of today, you will get $110 after 1 year. That is a $10 benefit or 10% benefit, right? So if you are not investing it here and if you are keeping the cash as it is, that means you are foregoing this 10% return. This is known as opportunity cost. So opportunity cost is next best option foregone. Anything that you have foregone is opportunity cost, and that's how you drive the discount rate. So discount rate would include the opportunity cost and would include the rate at which money is losing the value. So discount rate is that rate that you use to convert present value to future value or future value to present value. So the rate or the percentage by which you are discounting the future cash flows to present, that is known as discount rate. Here is an example. For example, buying a government bond for $800 today and getting $1,000 back after 1 year. So if you have bought a bond for $800 today and you are getting $1,000 after 1 year, that means you are getting some return. You are earning some return of $200. This $200 is your return that you are getting, and this $200 in percentage terms would be your discount rate. So here your future value is $1,000. Your present value is $800. So that means you invested $800 and in future you had $1,000. So what is the rate? The rate can be calculated doing 1,000, that is future value, divided by 800 minus 1. So in future you have this divided by present value and you subtract 1 from it, so it will be 1000 divided by 800 minus 1. You do it and you get your answer as answer that would be your discount rate. So simply speaking, this is just to explain you discount rate is what it is. It is the rate at which money will be losing value or at which money will be transferred from future to present or present to future, whatever. So there can be many types of discount rate. So for one investment, maybe you are using a 10% discount rate. For another investment, maybe you are using 15% or 12% discount rate. So there can be a different rate to discount back different investment. That would vary from investment to investment. Why? Because opportunity cost for each investment is different and discount rate is affected by the opportunity cost. So that's why discount rates can be different. But in practical world, if I ask you what is the discount rate of Pakistan, in practical world, when we say discount rate, we mean the policy rate by the central bank. So here we are discussing discount rate. That means theoretically that means any rate at which you are discounting. But I am just telling you that in practical world, when we say discount rate, so we mean the policy rate of state bank, the rate at which the rate that has been set by the central bank. Like for Pakistan, I think 5.75%. So this is about discount rate. Now a specific type of interest rate or discount rate is required rate of return. So what is required rate of return? Required rate of return is the rate that an investor would want on an investment. So if I tell you there is an investment A, and if I ask you to invest into it, you will ask for some return. So that return that you would ask for investment in A, that is your required rate of return. So required rate of return is the return that investor would ask for when investing in A. And how is this required rate of return derived or decided? So each investment would have certain characteristics. So key point to remember is whenever risk goes up, you need more return. So if an investment has higher risk associated with it, you will ask for higher return. If an investment has lower risk associated with it, you will ask for lower return, right? So as risk goes up, you continue to add premiums or in your required rate of return. And as risk goes down, you will decrease premiums from your required rate of return. So how do you come up with required rate of return? First of all, let's say this is an investment A. So first of all, before the base point is your risk-free rate. So you will find out what is the risk-free rate in the market. So let's say if we talk about Pakistan, and what is the risk-free rate in Pakistan? So we will start with a risk-free rate that is merely CIBOR. So we will start with a CIBOR. Or generally when we are doing all this exercise, then we assume 10-year PIB to be a risk-free rate in practical world. So you will start with a specific risk-free rate. It will depend on the investment, whether you take CIBOR, you take 10-year PIB or whatever. So you will select a risk-free rate. Let's say risk-free rate in the market is 5%. This is just a random number, 5%. Now you will come up to this investment. Now you know that without taking any risk, you can earn 5%, right? In real terms. There would be some inflation as well. So let's say this is a real rate. There would be some inflation as well. So let's say that inflation is not accounted for in this rate. So you can have two types of rates. Whenever we talk about this word real in finance or economics, we mean anything that has excluded the impact of inflation, that has not accounted for the impact of inflation. So real means anything that has not accounted for the impact of inflation, and nominal means anything that has accounted for the impact of inflation. So as this is real rate, this means this does not include inflation premium. Now you know there will be inflation in the market. So if there is inflation, your money will lose value. So for that you need some extra return, some premium to account for that inflation, because goods that are being sold for $100 today may be sold for $105 after 1 year. So you need some premium for that. So on top of it, you will add inflation premium. Let's say 2%. All these are random numbers just to explain the concept. So this is your inflation premium. Now moving on, next step is that now you will come up to this investment. This now 5 plus 2 becomes your nominal risk-free rate. That is risk-free rate including the impact of inflation. So 5 is real risk-free rate and 7 is your nominal risk-free rate. Now you come up to this investment. Now you know you can invest without taking any risk and get 7% return. If you are investing into this asset A, you will be taking certain risk, right? So for that risk, you will need some premium. So you will add that premium here, and then your total total return would become your required rate of return. Now, what kind of risks you may be taking? So generally, there can be 3 types of risk. So 3 major categories of risk. First is default risk premium. What is default risk? So if I am investing somewhere, I am giving my money to someone, right? For example, I am investing with you, I am giving my money to you. So there is a risk that you may default. You may not pay back my money at the end of the period, or you may are not able to pay me back the return or money or whatever. So that is a risk that I am taking. If I am not holding cash with myself, if I am not giving it to government, there is a risk that the other party can default. So if that defaults, or if it is not able to pay me, then that is a risk and I require a premium for that. This is also known as credit risk. So this is your credit risk or default risk. For this you will need a premium, and let's say that premium is, for example, 1%. So I need 1% premium for default risk. Now if the party has a high credit risk, is not trustworthy or does not have strong fundamentals, then this premium will be higher. If the party is very trustworthy, very strong, let's say a big company, then this premium will be lower. Now next comes another premium, that is liquidity premium. What is liquidity premium? So if I have invested money with you, now there is a possibility that I may need it in future, or if let's say I have purchased some shares of the company or some bond, then there is a possibility I may need money at some time in future or before that bond matures. And when I need money before the maturity of that bond, or whenever I need money when holding shares, I will need to sell that share or I will need to sell that bond. So when I need to sell it, I will need a buyer as well. So if a buyer is present and I am able to easily sell it, then that means it has high liquidity. So I wouldn't want a high premium, I would want a lower liquidity premium. Why? Because I am easily able to sell it. So liquidity relates to your ability to convert your investment into cash. So if you are able to convert it easily whenever you want to, then liquidity risk will be lower. And if risk is lower, premium will be lower. But if you are not able to convert it, or if you do not have enough buyers or sellers in the market, if the volumes are very low, then that means you will not be able to convert it into cash easily. And for that risk that you are taking, you will need a higher premium. So let's say that premium is 0.5%. Then next comes
higher liquidity, low return.
Higher liquidity, higher liquidity means lower risk. Lower risk means you will need lower premium. So lower premium means lower required rate of return. Lower liquidity means higher risk, and higher risk would mean higher premium and higher required rate of return. So you will need some premium for liquidity. Next comes maturity premium. What is maturity? So let's say this risk-free rate is for the investment of 1 year, and this A has and you are investing into A for, let's say, 5 years. This is a 5-year bond. So that means here your money is only stuck for 1 year, but here your money is stuck for 5 years. So if you are getting your money stuck for a longer period of time, you will require a premium for that as well. Why? Because there is a risk. So longer the period, higher would be the risk, higher would be the default risk, higher would be the any other kind of risk. Why? Because longer the time horizon, higher is the uncertainty. So the longer you go into future, the higher would be uncertainty. It would be difficult for you to predict future. and this is the risk that you are taking about the future. So that's why you will need a premium. So higher the maturity, higher the premium. Let's say it is 1% again. So now you come up to your total required rate of return 5, 2, 7, 8, 8.5 and 9.5. So this is your required rate of return from investment A. So this is how you drive required rate of return. There are many other methods as well that you come across in level 2, in level 3. There are many theories, models, but this is the basic. These are the basic premiums that you account for, or the broad categories of premium that you account for. There can be many other premiums that you are incorporating with respect to investment. These are the most important or the broad categories.